Hello, everybody. We are going to talk plug and play dividend stocks today. I'm breaking that out as its own separate page. I know there's a lot of people who really don't focus too much on the growth stocks, and I want to give people the ability just to focus on what they want to focus on. If you want to also have the growth stocks, there will be a plug and play growth stocks, and you can pick what it is you like best. So, what's going on with dividend stocks right now? First off, I don't focus on highest yield. I think focusing on the highest yield in general is usually a bad idea, because if the underlying business is not solid enough to carry that dividend long term, eventually the market figures it out and prices the stock much lower, either before the dividend gets cut or as it gets cut, right after it gets cut. We just saw that with Intel. Intel stock has been in the middle to upper 20s for a year. And people were like, well, what if they cut the dividend? Which I didn't really think was going to happen, but the market priced it in. When the dividend finally got cut, stock price stayed the same. So that was an example of the market pricing in a dividend cut way ahead of schedule, which means that probably there were insiders who knew that it was coming and they were just looking for a spot. There's other cases when a dividend gets cut and people don't see it coming at all and the stock just falls off a cliff. I think that there are dozens and dozens of those coming to the S&P 500, if not north of 100. When I pick out a dividend company, I'm looking for a healthy balance sheet, at least some growth, growth that'll outpace inflation, and a management that is returning money to the shareholders in a way that maximizes the value. And that often will mean some share buybacks. The combination of share buybacks plus dividends is what's called shareholder yield. The higher your shareholder yield, and this is something that you can screen for at Stock Rover, usually the better. The only exceptions if debt is going up to pay for the dividends and the share buybacks. Now, that's especially important today because there were plenty of companies that were buying back shares and paying dividends because they could borrow for almost nothing. Now we are in an era that probably lasts a few years where interest rates will at least be something. And that means that as these companies have to refinance their debt, they're going to have a problem. So I'm going to focus on dividend stocks, and I'm going to do a lot of coverage of companies that I think are high risk, just to put it on Seeking Alpha and get the attention of people who are in those companies. And I want them to be able to think, maybe this isn't as safe as I thought it was. And then we'll pick out the companies that do have underlying growth and a solid balance sheet and a management that's on your side. Now, many of the REITs are in a tough spot now. And we've talked about this before. And we know that a lot of real estate has to be remodeled and redeveloped here over the next several years, including office towers that are at about half occupancy. What do you do with the other half of the space? And now they have to do it with higher interest rates. So not only are a lot of loans coming due that have to be reset 3, 4, 5 percentage points higher in the face of rents that might not be there, and borrowing the money to do the redevelopment is more expensive too. When you switch over to utilities, which a lot of people like to invest in because they're regulated, what you see is that not a lot of utilities are in a great spot because they have pretty big legacy expenses and massive expenses to transition to clean energy, which is happening faster and faster. The energy stocks, and we'll call them the fossil fuel stocks for now, do actually appear poised for another trade higher. And I think it'll probably be the last bull market in oil and gas stocks. I thought that could have had happened in 2018 and 19, but COVID reset things, killed a lot of investment. And with the majority of people supporting ESG, and I'll show you some numbers on that, some sustainability facts that should smack you right in the head, follow the money stuff. What you will see is that there's no end in sight for clean energy. In fact, we are probably in the first or second inning. Probably second inning, and oil stocks are basically in extra innings. Now, does that mean that they can't stay tied for a while and keep pumping out returns? It doesn't mean that at all. I think that there are certain oil stocks and gas stocks that will do well. They have a combination of good rock, cheap assets, and they have a transition plan to the clean energy future. Carbon capture in the case of many of the big oil and gas companies, and natural gas in the case of some others, hydrogen in the case of others. Those companies that are pure frackers, they don't really have any transition plan. They're in big trouble. And they're in big trouble because they have high graded all along the way. What does that mean? They focused on getting oil from the cheapest places they could. So if they had, say, 500 frackable sites, the ones that were the cheapest and easiest to get to the oil is the ones they did first. And now they're moving into the harder and more expensive places to get oil from. If oil prices don't stay high, they can't economically do those. And then we're not in an environment where investors will support taking on debt to produce more oil and gas. So while peak oil demand is right on top of us right now, it might go a little higher in the next few years, not much. We can see the curves turning over, and I'll show you some of that here in a second. And it's just a matter of literally at what point is there demand destruction for oil? Probably late this decade, around 2030. And at what point is there not enough oil to be produced to cover the demand? I would suggest that right now, oil markets are roughly in equilibrium, but there will be a small shortage for the next year or two, mainly because of OPEC and Russia with less supply and China with more demand. That's what that video was before we started. In the middle part, he talked about China demand, which is something that I've been talking about for months. So we have a combination in the oil markets where supply is slowly going up in a few places, the United States being one of them, but demand is about to get a huge jolt from China. And that's why I showed it last week. China's been buying up oil all over the world again on this little dip, including American oil when they get their hands on it. When you flip that over to natural gas, Russia had been supplying about 40% of natural gas to Europe. There is no way for Europe to quickly replace that. The mild winter saved them. But how do you fill a 40% gap, especially now that Russia is completely closing and starting to dismantle the pipelines? Even if Lil Vladdy was gone tomorrow, probably still take a year or two to get that gas back online. So in the very short term, I'd say the next 2 to 3 years, there's probably a decent trade in oil and gas stocks. I'm still going to focus on those that have a transition plan and those that have some sort of backstop, some giant buyer out there supporting the shares. So let's talk about what's going on. Bloomberg had an article out this morning. Stock market's fate comes down to the next 13 trading sessions. And they focused on a few things. First of all, they talked about volatility not really being priced in just yet. A couple of days that the traders are trading. You can see the big difference. Looking at a 36 on this day, the FOMC meeting, dropping all the way down to 19 the next day. People ask me all the time, how can the market move so fast? What's it telling us? And I say it's just traders being traders. They can do this. That's a 70% difference on volatility. Now, they can't drop stock prices 70% in a day, probably, because of the circuit breakers. But because only a certain amount of the float is available, right? Not all shares trade. A lot of shares are locked up by long-term investors. The shares that trade, especially when you consider how active options markets have become in the last 3 years, right? We're 3 years from the start of the option market explosion, which coincided with COVID and everybody going home and deciding they were a trader. I mean, for the good traders, having all those bad traders in there has been awesome. The problem is that a lot of those bad traders are younger and they're just saying piss on the stock market altogether. That's bad. We need them to invest in the long term. And eventually they come back because they see it go up. And eventually it goes up because the Fed backs off. And eventually there's more quantitative easing. There will have to be eventually. There is no way mathematically for there not to be quantitative easing in the future. Can't be done. Eventually we might not need it decades and decades from now as the demographics even out. But in the next decade, we will need massive quantitative easing again because getting over the boomer bust hurdle is going to be tough. In the shorter term, I'm going to go back and forth between short and long term here a number of times today because I think it's important in the way you think. I'm going to give you a nugget at the end that I want you to get married to, unless, of course, you're a superstar trader. Powell is testifying to Congress Tuesday and Wednesday this week. There's a jobs report coming up, inflation data, and then the Fed decision on rates. Will they raise a quarter point or a half a point? And the consensus was a quarter point up until about a week ago. And now all of a sudden it's coin flip between a quarter point and a half point. That's bad for the market. There needs to be some consensus. And I think maybe after Wednesday, after Chairman Powell has been in front of Congress for a couple of days, we'll start to get that consensus. Either the market starts to push towards the half point or starts to push towards the quarter point. I will tell you, if the market starts to push towards the half point, that's going to put incredible pressure on stocks. So we'll see. Bloomberg finally agrees with Kirk Spano. That's nice. Holding extra cash is a great idea because it gives you optionality for what's coming. You don't always have to predict everything. You just have to know the scenarios. And if risk is high, hold a little extra cash. We know that risk is high. Not only do we have to worry about inflation, particularly energy inflation. I know there's a lot of breathiness about services inflation, but I think the reality is that just helps the middle class. Your educated, skilled middle class is doing better. So if you long for the days where all the money went to the richest people, sorry. But I think people being employed and being compensated is pretty good for most people who are employed. And that means that there's pressure on some of the corporations because if margins contract because wages are 2 or 3% higher, the investors go nuts. Well, wait. How come we're not pulling more out of the employees? How come we're not raising rates more, raising fees more, raising prices more? Why aren't earnings going to go up perpetually for everything? Well, in an era where you could borrow for nothing and you had higher unemployment and you could exploit the opportunities without much fear of repercussion, and even without having a good business model to begin with in many cases, a lot of things were covered up. The tide is going out on companies that really weren't that good to begin with. As an investor, you need to recognize the cycle that we're in. The cycle is at least some interest rate versus almost no interest rate for borrowing and for financing the largesse of executives that we've been doing for over 4 decades now, and really culminated in the 2000s, ever since I'd say about 2003. And then really right after the financial crisis when interest rates went to near zero. There has been a gouging within the economy. And this has nothing to do with ideology. It's purely facts-based numbers. And it's harder to gouge and pull money out when money is tighter versus looser. When money is cheap and loose, it's easy to stick your greedy little paws in there because everybody's making money and they don't usually realize how much they should have made. And now with money being tighter, honesty and profitability and fairness and good business models are going to have a much bigger advantage over the crappy, unfair, crony-led business models. There will actually be losers. And it will be even more apparent in the dividend space than I think the growth space, because growth is easy. If it's growing and margins are expanding, you can invest in it. With the dividend companies, people look and say, oh, 6%. But what if the dividend coverage isn't very good and they have to cut their dividend in half or by 75%? And the know-nothing investors suddenly get shocked. They complain. They blame everybody else. But in reality, the numbers are all right in front of you. There are a lot of companies that cannot support their dividend without super cheap money. I think the COVID bailouts gave most companies about 5 years to right their ship. And I don't think that the majority of companies did it. So let's talk about oil, because I think energy is a place where you can invest both for the short term and the long term. In the very short term, the next 2 or 3 years, there's going to be tight oil and gas supply and demand, mainly because OPEC is keeping the spigots tight. Russia's leaders are assholes, and China is reopening in a curiously timed move. The geopolitics of this should not be ignored. The war right now is economic. And in the short term, what China and Russia are trying to do is put pressure on the United States and the Western world to make bad decisions. Because when you have freedom, you can act like a jerk. You can vote like a moron. It's allowed. They're trying to take our greatest strengths and turn them into weaknesses. I had a kid at poker the other night who is re-enlisting into the Navy tell me that we should not be meddling in Ukraine. And I asked him, I said, what makes you think that? He goes, well, all that money and blah, blah, blah. I'm like, dude, we piss money. There is nothing economically or financially daunting about sending weapons to Ukraine. What would be worse is the cost it would take to protect the rest of Europe from Russia if they were able to take over Ukraine. Think that through. What would the United States and Europe have to spend if an aggressive Russian leadership got all the way to the doorstep of the rest of Greater Europe? Certainly more than billions that we're spending now. So I explained this to the kid. Well, we just shouldn't be anywhere. I said, well, then why are you re-enlisting? In any case, peak oil demand. We're really close to it, but in the short run, there's a lack of supply to cover it. Those curves are going to cross over sometime this decade, where demand will stop going up. Again, I continue to point to the year 2026, and supply will keep going up. And then eventually supply will start coming down, but it won't be as fast as demand. So we'll probably have really cheap oil by the end of the decade, 2030-ish. And I will give you some ideas here. This is BP, which shows you the range of projections. The Sustainable Development Model from the IEA has oil demand dropping about 25% by 2040. That's probably unlikely, but getting close is not unlikely. BP, probably about 15 to 20% drop in oil demand by 2040. Now, these are all producers, and they're all basing their numbers on population growth. The problem is that the people entering population today, by the time they're drivers, they'll be driving EVs, and older people drive less. So take this with a grain of salt, because these are all the oil producers talking their book. BP allows for these two scenarios. I think that this one here is probably most likely turning over somewhere between 2026 and 2030-ish. Wood Mac's got a weird curve. I think they'll revise theirs. McKinsey has been. Deloitte and all the other accounting firms have been. Something similar to this light green line up to this dark green line is probably what's going to happen. Now, if there's another shock to prices, think this through. If in the next 2 or 3 years, price of oil goes over 100 and is there and really entrenches itself in the collective psyche, what happens in 2026 when the mileage requirements on the car producers go up at the same time that they have the capability to make millions and millions more EVs? We're only 2 to 3 years away from it. The metals and minerals are there. Tesla made a major announcement that everybody ignored the other day. A lot of those rare earth metals aren't going to be necessary for the motors. Technology is improving so fast that all the people who say we don't have enough of this, we don't have enough of that, all the people who keep crying commodity boom. Yeah, short term, because in the long term, technology changes the equation. Think of your old algebra. So with oil, just consider that the supply, the money that could go into more supply, is going into dividends and share buybacks. There is a calculation by the energy industry, both state-owned and independent companies that aren't controlled by China, Russia, or OPEC, that they can ride this for a few years and cash in. Now, certain companies are just going to make as much cash as they can, and they'll probably disappear or get bought. Other companies will put money into the energy transition and try to sustain their companies long term. You know which two that I want to own. And just to make the point of where the pressure is coming, it is constrained output by OPEC and Russia now, and the increase in demand from China. It's geopolitical in nature. There's no doubt about it. And we just have to build out the clean energy and the EVs so they don't have the power to do what they're doing. This is from the oil barrel, peak oil barrel. And I would encourage you to look at this once in a while. Pretty good information. Oil supply hasn't quite gotten back to the highs, 2019, but probably will be by, look at this, 2026. How will that happen? Well, first off, ask yourself a question about Russia. Do you really think that they can survive economically without these sales? Can they really live on selling 70 to 80% of what they were selling a year ago? No, they can't. At some point, Lil Vladdy is gone. And a lot of this oil and gas comes back on the market. Just that will hammer prices. The emerging markets that produce oil, particularly the 10 largest ones in Africa, they need the money, right? And Africa's big 10 producers can get this number to come back up, which they probably can with our help. We've already seen 2 deals, big deals in Africa, right? Then again, middle of the decade sometime, you have oil and gas that comes back onto the market. And they're already working on it. Not speculating here. It's already happening. It's from McKinsey. McKinsey doesn't mess around. So what you're going to see is there's 10 countries in Africa that produce oil, a non-negligible amount, and they're trying to get their numbers back up. And they will. It won't be a skyrocket amount, but it'll be 1 million or 2 barrels a day, and that'll be enough. So instead of the global market being short of oil by 1 million or 2 barrels per day, which is what it is now, once demand starts falling, even just levels off in a few years, and supply goes up with what? Panic pumping. Russia brings oil back on the market. Africa has any success. Venezuela has any success. You get to a point sometime later this decade, and the market will understand it before it happens, where now all of a sudden there's downward pressure on energy prices. Some of these numbers are going to go up. Not many of them are going to go down because they're about as bad as they can get. But where is the real big money going? If you go to this website, Sustainable Energy in America Fact Book is here. It's helped produced by Bloomberg. Here are some of the facts. I know we're in a post-fact world, but here's some of the facts. Total U.S. energy consumption rose 2.95% as we continue to rebound from COVID. And we're basically back to where we were in 2019. It took 3 years to get back to 2019. Where was the investment? 141 billion. And there's, the government's going to put in at least that much over the next few years. Went towards clean energy technologies, including renewables, electric vehicles, and essentially efficiency. 32 gigawatts of new renewable power generating capacity was added to the grid as the grid continues to be rebuilt as they go. It's not like we're not rebuilding the grid. It's a huge project that's going on right now. Go read the reports from American Transmission Company, or really any utility that owns transmission lines. They're pouring tons of money into it. So right now, renewables are meeting 13% of total U.S. energy, about 11% if you peel out nuclear, and 23%, almost a quarter of electricity demand is from renewables now. How many of you knew that? It's a quarter. A quarter of the grid is renewables now. And it's growing double digits every year, 10, 15%. So at 10% growth, that means in just 7 years, half of the grid will be renewables. What does that do to coal and gas? Again, I'm telling you, prices are going to come down. It's not as far away as people think. So if you're making energy trades, you have to think a year or two, not 5 or 10. The United States is also the largest energy storage market. We have all kinds of space here. So we don't have to use the most expensive technologies. We can use the bigger, cheaper ones, right? The more expensive technologies have to do with storage in small spaces, like with cars. But even that technology is getting much, much better. So we can go through all the stats, and what we can see is this. There's so much money going into the clean energy transition that's hard to invest it all. This is just something that's going on in the EU. So one of the arguments from people who are like, no, oil and gas forever, is that, there's not a big change going on, and they can't, fix the grid fast enough, and they don't have the materials and metals. It's all bullshit. How could this be happening if it wasn't bullshit? How could we already be a quarter of the way to making the grid almost all renewables? Now Rolls-Royce, and I forget the other company, I think GE might be doing it too still. The small nuclear reactors, while not as clean as what we want, are still going to get some use, because it's impossible to build a big one in most of the world unless you have an authoritarian government. But the little ones, they'll put those little ones, half underground somewhere, power some houses. The UK is going to be a big user. We'll see about the rest of Europe. The promise for nuclear was that they'd be able to get the waste to be so negligible that nobody would oppose it. They have not succeeded on that. So when you hear small nuclear reactor, big deal. We've been putting those on subs for decades. The real big deal is if they could get rid of most of the waste. And they have not been able to do that yet. And I have followed this since I was in college. So in 30 years, this idea has been around over 30 years, I mean, since before I was in college, and it still isn't doing what it wants. So what does that mean? That means that nuclear is not that big of a deal. It means that uranium prices are probably going to crash again. It means that all those investment letters that pump up, those 3 or 4 uranium companies every couple of years, right? It's all sucker investments. Unless they get rid of the waste, you're never going to see these things in many places. They'll be around for a little bit of base load and backup and on military bases, things like that. Nuclear is not a big deal. What is a big deal is solar, because it's way cheaper. You don't have to mine hardly anything anymore. We have the technology. The technology keeps getting better. The price of solar came down 90% in the last decade. It's probably going to get cut in half again in the next 3 years. Solar's cheap. I mean, it's cheaper than coal. That's why they're tearing down coal power plants. The expense is in the batteries. 2 years ago, I told you the technology was right on top of us, and now it is. The discoveries had already been made, and now we're getting into production phases. The things that Tesla hinted at, but didn't do a song and dance about, those should be very interesting. I talked to you about the metal that they can basically create in a lab now that replaces rare earth metals, how they can use iron and other chemicals for the lithium batteries, reducing the amount of lithium they need, their anodes and cathodes and things like that. And I'm pounding this today. Let's go all the way back to the start. What did we talk about? What is going to determine the short term of the stock market? It's going to be what the Fed does. I think the Fed's going to be pretty aggressive here again for a little while. Morgan Stanley thinks the stock market will drop 20%. Clean energy investments have already fallen in price. Utilities haven't yet. They're going to have to, because they're very financing dependent. The energy companies are going to bifurcate. It's already been happening. We've already talked about it. There's a company called New Fortress Energy. Its price is much higher than it was 3 years ago. How much higher? So much higher that it's leading stock in the category. It's a weird company because it's kind of a hybrid energy producer and utility. Consider it regulated gas. But what else are they getting into? Hydrogen. They build the infrastructure, and they have a way of getting natural gas from the ocean that gets rid of a ton of the expenses and makes it faster. Take the natural gas from the wellhead, convert it at sea, and put it on a barge versus transporting it to the Gulf Coast, having it converted, then put on a barge. Much higher margins. The price versus the cash flow is at the lowest point for 5 years. You should be buying the dips on New Fortress Energy, and you just got one. I haven't even looked at the prices in the stock market today. I don't even know if we're up or down. But if you can get New Fortress Energy in the 30s, you're silly not to, and just keep selling those cash secured puts that we've been selling. Energy is another one. Now I need to take a look at. These are ranked by 3-year performance. Renewable, gas, renewable. Right? Normally it would say regulated electric everywhere. Those aren't the ones doing well. Why? Why are the regulated electric at the bottom and the diversified? All those expenses. Okay. So if you're a utility investor, you have to know what the expense structures are at these companies. How much do they have to put in the transition? Are they ahead or are they behind? Do they have anything that differentiates them? New Fortress Energy does. This one's been such a layup. Their fast natural gas technology is so unique, and they're building all of this natural gas infrastructure, which we know is convertible into hydrogen. This is going to be an S&P 500 company someday. It's only $7 billion right now. This is going to be a $20 to $30 billion company this decade, and they're pumping out a dividend, right? They had the special dividend, so 9.4% last year. May not be that high this year. Don't buy it for the 9.4%. But they pay out special dividends. And it's because of the nature of the ownership of the company. Wes Edens, owner of the Milwaukee Bucks, or at least half of the Milwaukee Bucks, he wants that cash. So when he can, he takes some out because he's a huge shareholder, 14, 15% of the company or something. So he's on your side. The CEO of the company is on your side. And they're going to probably buy back shares at some point. All right. So if you haven't used Stock Rover and you haven't bought it yet, and you want to do your own research, buy Stock Rover for $20 a month. I've got the links on the websites. Investopedia rated this the best long-term investor screening and monitoring and portfolio watching website out there. There's so much data here. If we pop this out, and you want to look at different types of charts, you can do it. You just pick out what you want to look at. It's almost as good as Y charts for this stuff. But the screening to me is just off the charts good. Right? I build my own build my own screens and I use their library too. So, all right. Anyway, dividend stocks, we need to focus on REITs, utilities, and energy stocks here for a while because we're going to get an opportunity in REITs, and there's a few that are already there. Utilities are going to be in two groups. Energy stocks are going to be in two groups. You got to pick from the right groups. Here's the little nugget I'm going to give you. Stop trying to predict the short-term future. Just understand where the trends are. And when prices come back to you, react. Everybody wants to predict and try to be a superstar. And I'm better at it than 4 out of 5 people in my business, maybe 9 out of 10, probably 9 out of 10. But where we really make money is when you say, hey, this is a great idea. I wasn't in on it as an insider because how could you be? It went up the slope of hope. Now it came down because time takes time to be time. And I can get a cheap price on something like New Fortress Energy that's paying a dividend. So react and react in a smart way. And if you've prepared yourself, if you understand the big trends, you know how to follow the money, you just wait for those crazy traders to give you a softball. You know, that 80-mile-an-hour fastball right down the middle. I lived on those. Some kid gets behind in the count 3-1, has to throw a fastball down the middle. He only throws 80 because, I'm an amateur. I can hit that. I was a swinging at Randy Johnson 102-mile-an-hour pitches, right? Wait for the fastball down the middle because the traders will give it to you. You won't have them for long. Traders whip prices around and they flip the switch. They push it down, 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 down. They go, oh my God. And they push it back up, all in the space of a month sometimes. I think the Fed is going to be mean this month. If they are, the Morgan Stanley scenario plays out, and we see the stock market drop double digits. I don't know if we'll quite get to 20%, but maybe. And a lot of these great ideas are there. So I'm going to put the plug and play dividend stocks up this week and the plug and play growth stocks over the weekend. You're going to get these a couple of weeks early. I know I've been a couple of weeks late on other things. I want you to think about what you can do to really position yourself for what's coming for the next year or two, sure, but also for the longer term. Because if you can actually have a set it and forget it moment where you can put together a portfolio that you can let ride for, until the next crisis, you're in great shape. One thing I will tell you that I did, and I wrote the article a few weeks ago where I mentioned all those covered calls. I wrote those covered calls, and none of them are going to get called away, it doesn't look like, especially if the Fed is mean. Now, if Powell is nice the next couple of days, then we're going to get a heck of a rally until these other dates go by. When we actually get the actual Fed number in a couple of weeks. I would say that any big rallies in the short term should be met with trimming and selling covered calls. But I don't think any correction is going to last long. I do think we start a bull market by the end of the year. So between now and then, we're just looking for spots to buy. Unless you're over leveraged right now and don't have enough cash, in which case find a way to raise a little cash. You don't have a lot of time, I don't think. A couple days to several weeks. Stock market seasonality is that the market usually will go up in March and early April. I think that's going to be condensed if the Fed is mean, and it might play out if the Fed is nice. But May and June, usually not so hot. The earnings weren't all that great. We had the first year in a decade, well, excluding 2020, where earnings actually went down. The great divergence that I have talked about has started. It's not coming, it's started. And you're starting to see articles say the same things that I've been saying for a year or two now. Just showed you an example from Bloomberg. It made it a big deal, something I've been telling you for a year. It's coming. And one thing to keep in mind here is while I'm pretty good at this, a lot of it is that I just read stuff that doesn't make it to the mainstream media 6 months before it gets there. A lot of information is out there months and months ahead of the mainstream media publishing it. That's probably my biggest edge, is just having the information earlier. And I understand the economics in general. So react. Don't think that you have to predict the world to the minute. If you know the big picture for the long term, you let the short term give you opportunities, and then believe what Warren Buffett and Charlie Munger tell you. Is that the stock market is a place to transfer money from the impatient to the patient. You'll get rich doing that, even if you're not a superstar trader. All right, take care.